I'm very concerned that the chairman of the Federal Reserve has not taken on board the real risks associated with climate change.
Going green will have a cost, but there's also a huge opportunity for business and investment.
We have a generation of central bankers who are defining themselves by their wokeness.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Fed minutes flag an imminent start to tapering, while pandemic stimulus in the U.S. could end by mid-2022. CPI prints above 5% again. China feels the price pressure as well. Factory inflation hits a 26-year high. The PBOC governor says inflation is moderate overall. And Ana Botin exclusive, the Santander executive chair, tells us that she sees inflation as temporary, spurred by COVID. More from that interview throughout the hour. Now, first thing is first, let's check in on the markets. Now, of course, the debate is always on inflation, of what we'll hear from the Fed. A bit of repricing when it comes to treasuries. We're seeing a nice lift to the stocks Europe 600. The S&P 500 futures also gaining some 0.6%. You can see we actually had a repricing from HSBC on the 10-year yield. That was from Stephen Major. 1.53 is where we're seeing it right now. And then the story with crude oil, we'll speak to the IEA shortly. The big stories, of course, is energy producers in the UK also going under. But the Turkish lira sliding, that's one of our biggest market stories, sliding to another record after President Erdogan fired 3 central bankers in a midnight decree. Now, the ousters really come, we understand, after the president met with the governor and the targets opposed Erdogan's push for lower rates. The shakeup really paves the way now for even more exertion from the Turkish president, and he is a self-described enemy of interest rates. And that's something that, of course, we've been talking about. He espouses unconventional theory that reduces interest rates will lead to lower inflation. That's the slide of the Turkish lira over the last 3 years. If you look at some of the materials, I mean, look at the UK quite significantly, because energy prices are seeing a lot more pressure in the UK than elsewhere in Europe. And then, of course, we had Vladimir Putin saying, well, he's happy to send a lot of the things, or a lot of the gas supplies over to Europe. A lot of these leaders, of course, have to ask at what price. But for the moment, we're seeing a little bit of a lift to a lot of these European indices. Now, the IEA has released its latest monthly report. They say the ongoing energy crisis has prompted a move to oil that could boost demand by 500,000 barrels a day. Now, the agency says there's been a massive switch to oil products and direct crude use for power generation. Well, we're now joined by the IEA's oil market division head, Toril Bozzoni. Toril, as always, thank you so much for giving us a little bit of your busy schedule. When do you see things normalizing a little bit? I mean, we had this energy supply shock, more people now wanting to use oil. Does it stabilize, or do we increase our demand for oil overall?
Good morning, and thank you for having me. Yes, as you said, the energy crisis that we're seeing, the increase in natural gas, coal, LNG, is prompting many consumers to switch to the use of oil for power generation. We're seeing increased use of oil in standalone generators where there's power shortages. So we have increased our demand for oil for the rest of this year and into 2022. By about 500,000 barrels a day, as you said, due to the switching to oil from other energy sources. As a whole, we raised our forecast for growth this year by about 200,000 barrels a day, the same for 2022. So now we're seeing growth of 5.5 million barrels a day this year, another 3 million barrels a day in 2022. Of course, the higher energy prices is also...
Yeah, I mean, I guess a follow-up to that is, given what, the numbers that you've just laid out, what does it mean for OPEC Plus? Do they need to reconvene and put more barrels of oil on the market?
As we say in our market, we're seeing really strong supply growth also in the coming months. From September to the end of the year, we're expecting oil supply on a global level to increase by 2.7 million barrels a day. That will go a long way to meet the increased demand for oil. But as our balances show, it's not enough to meet the demand for the remainder of this year. So we already seen oil inventories declining very rapidly all over 2021 and since the peak mid-2020. And we're expecting those stock draws to continue until the end of this year. The market will remain tight. Obviously, if it's a colder winter, we could see even stronger demand for oil the rest of this year. So the market will remain in deficit as we see it based on our forecast for demand through the end of the year. 2022 is looking a bit better. So if we don't see a very, very cold winter and even stronger demand, we're expecting things to improve in 2022. But at that time, even if supply could exceed demand at that time, it will be needed to replenish the inventories that are already way below the 5-year average that we're seeing. So we're seeing things improving, but the market will remain tight for some months more to come.
Toril, we heard, for example, Citigroup actually expecting 1 million barrels a day or more as a possibility because of the switching from gas to oil. You're confident that actually rebalances. Are you confident in your forecasts on this? Could you have to actually put them right? I mean, are the analysts wrong, or are you just very prudent in calculating the switch?
Well, we've taken a very close look at the capacities that are available in power generation across the world. We're seeing some switching already taking place in China, in India, in Asian countries, Japan, also in Europe. But based on the capacity that we think is available, switching from gas to oil in terms of standalone generators, we think that the 500,000 barrels a day of extra demand on top of what would normally been the case under normal circumstances, we're pretty confident. Of course, the higher energy prices, the blackouts, rolling blackouts in many countries has also led to slowdown in industrial activity. We saw that even before the latest run-up in prices. Production, a lot of industry, energy-intensive industry, have been forced to stop or reduce their activities due to the high energy cost or due to the lack of electricity. So this will have an offsetting impact on energy demand, we think. And as we've seen in the latest economic forecast for major institutions, they're already downgrading their growth for this year. And lastly, just to say, as oil prices are rising, we're now at 7-year highs. As you said, gasoline prices are also at record high in many countries. And this, we think, also will have a dampening impact on demand going forward as consumers faced by higher energy prices are reducing their demand.
Thank you so much. Toril Bozzoni there, head of the IEA Oil Market Division, joining us this morning. Now, the energy crunch has closed 2 more UK energy providers, Pure Planet and Colorado Energy, closing affecting 250,000 customers. Now, this news comes as UK gas supplier CNG Group announces it will stop providing gas to its utility clients, foreshadowing further closures. In total, 12 energy companies have closed so far since August, affecting 2 million households. Well, to discuss all of this is Bloomberg's Jess Shankelman. Jess, great to speak to you. So what do these closures actually mean for the industry?
Hi, Francine. Yeah, so we've got a bit of a chicken and egg situation here with CNG. Another 250,000 consumers are this morning discovering that their energy supplier has gone bust. CNG says it's going to stop supplying gas to the UK, but it has another 18 suppliers which now are going to be threatened by this move, which means even more small suppliers find themselves at risk of going bust this morning.
So is the market only suitable for large companies? And actually, how much more pain, Jess, will we see here in the UK?
Yeah, well, I think you have to look back. A couple of years ago, people were complaining that the UK energy supply market was dominated by the big 6 companies. So what the UK government did was they tried to introduce more competition into the market. And at one point, we had 70 different suppliers as a result of that. That was great for consumers. Many people I know, they switched to smaller suppliers that were promising different things like cheaper energy or greener energy than the big 6 were offering. But what's happened is that those smaller suppliers they didn't have the cash to hedge against volatility in the market, and as a result, they've been unable to stay afloat. So the way the UK market works, the rules are that the bigger suppliers then have to kind of swallow up the smaller customers that now find themselves without a supplier. So it does look like we're heading back to a situation where the bigger companies have the margins and the cash to be able to deal with this kind of volatility.
Jess, thank you so much. Jess Schenkelman there joining us with the very latest. Now, coming up, the death of the 60/40 portfolio. Up next, we speak to Christian Muller-Gleesman, Goldman Sachs Managing Director for Portfolio Strategy. We'll ask him why he thinks now's the time to pull the plug on one of Wall Street's favorite strategies. This is Bloomberg.
We have in-market scale and global scale. And so our global scale is 150 million customers. In 2019, I think with you here in London, we said we'll be investing 20 billion over the next 4 years in technology to make the transformation. We very much believe we need, and we had decided to work along three verticals or three strategic, let's say, priorities. One is what we call the One Santander. How do we make a single global platform that is at the same time able to compete locally? Again, 150 million customers across Europe and the Americas. The other one is our PagoNext, which is our global payments company. Yeah. And then we have the digital consumer bank. So we're going to both do it inside the bank and also within an autonomous payments company that we believe can be one of the top 10, 15 global payment companies in the medium term.
Santander Chair there, Ana Botin, speaking exclusively to Bloomberg. We'll hear more from our interview with Ana Botin throughout the program. Now, Wall Street is turning sour on one of its most popular investment strategies. A growing chorus says the recent synchronized sell-off in equities and bonds is just the beginning, and it spells disaster for the 60/40 portfolio. Goldman Sachs says the growing dominance of technology means bonds present a greater risk than when the strategy was popularized, and that losses from 60% stocks, 40% bond portfolios could swell to 10%. The death of this particular strategy has been called before by Bank of America back in 2019. So how did that bet fare? The 60/40 model returned 27% on the year. So is anything different this time around? Well, we're joined by Christian Muller-Gleesman. He's Goldman Sachs Managing Director for Portfolio Strategy at Asset Allocation. He was one of the authors of Goldman's report signaling the end of the 60/40 strategy. So thank you so much for joining us. As always, Christian, give us a sense of actually what replaces the 60/40 portfolio strategy.
Yeah, listen, I think the problem with that strategy is a bit like the problem with investing in general. Like everything is expensive, and it has been expensive for a few years. So I'm not surprised at all that you had other people worried about the 60/40 portfolio before. We actually wrote a report in 2017 called The Balance Bear, and I think little did we know that things could get more expensive and real rates could go even lower. But at the margin they did. But it doesn't change the fact that you're at a very poor starting point with regards to valuations. And at the margin, the big problem is that essentially both equities and bonds are expensive at the same time. No, and I think that's a big difference compared to the past, where bonds were usually buffering equities on the way down when they were kind of struggling, and vice versa. Actually, equities were a very good hedge for bonds when they were selling off. And that's getting much tougher now because you mentioned it earlier, tech and like secular growth stocks are such a big proportion of the market now that they actually suffer if rates are going higher. So net equities cannot do as well as they used to in bond bear markets because the index makeup is not really benefiting that much from higher rates. So you were asking what's replacing it? Listen, tough when everything is expensive, no, but happy to talk about some strategies we've devised, but in the end, it will require a much more in-depth approach, much less buy and hold, much more broadening of diversification, much more use of derivatives.
What does it mean, Christian, for some of the repricing that we've seen? I don't know whether it's Treasury or actually equities. What's your main concern right now? Is it still inflation and central bank policy mistakes?
Listen, you hit the nail on the head there. I think the big problem, besides the elevated valuations, is that we're going through a period of rising inflation expectations, rising inflation surprises, with somewhat good growth levels, but negative macro surprises and at the margin concerns about growth, not just for the next few months, but the next cycle. And that means both equities and bonds are currently having headwinds. But as you said, the big problem in all of this is central banks, because you can deal with the higher inflation and you can deal with high inflation expectations. We've had that for the last year. But the important thing to watch is the real yield. Is the TIPS yield actually starting to move higher? And you might have noticed the drawdown in 60-40 portfolios, which peaked at kind of 4% or so. That came alongside rising real yields. And that is the big problem, because that weighs both on equities and bonds at the same time. And they're very closely linked to what central banks are doing, because so far the higher inflation hasn't really led to longer dated real yields going up for a variety of reasons, but the key one being that the market doesn't believe it will trigger a really strong, prolonged Fed rate hike cycle.
So, Christian, what would you be buying right now?
Listen, at the margin, asset allocation is all relative. So you kind of need to think about, like, if everything is expensive, you need to kind of tilt your portfolio to the least expensive areas. And clearly, you need to also accept that your absolute return potential is more limited. And you need to think about more new approaches to achieve the best returns. So what does that mean? At the margin, we think that more diversification within assets is important. So the last cycle was all about owning US equities, owning US tech, and just sitting on it. And we think the coming cycle will be much more about diversifying portfolios regionally, across styles, across sectors, focusing on alpha. I think that seems somewhat obvious, but it's going to be more difficult. It's going to be less easy. And in terms of the bond proportion, you need to think of new ways how to protect the portfolio. No, you cannot rely on bonds only. That might mean you have a bit more real assets to address the inflation risk. It might mean that you're using derivatives or tactical or risk management strategies like vol targeting a bit more. But the key goal always has to be to steepen the efficient frontier. Now, that's how you kind of essentially position yourself in the best way for a low return period. You try to get a steeper efficient frontier. And as you know, it's not really about the 60-40 portfolio. You need to find the optimal risk reward, and then theoretically you should lever that. In the last cycle, the best portfolio was actually not 60-40. It was a risk parity strategy, which is more like 40-60. So from that perspective, the coming cycle, we feel that you want to own a bit more equity than in the last cycle based on that optimal portfolio. So maybe it is more like 60-40, but the 60% is not the S&P and the 40% is not bonds. You kind of need to find a few different opportunities, both in the risky bucket and in the safe bucket.
Christian, thank you so much. Christian Müller-Gleesman from Goldman Sachs. Now, later on in the program, we also hear more from my exclusive interview with Ana Botin. The Santander chair told me she sees the current inflation spike as temporary. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Germany's Olaf Scholz says an SPD-led government will drive forward an expansion in renewables and energy infrastructure investment. On a two-day trip to Washington as Germany's finance minister, he expressed confidence that he'll form a government by Christmas. Speaking to Bloomberg TV, he also weighed in on Europe's energy crisis.
There are a lot of prices that increased for oil and gas, for instance, which is also due to the economic recovery we see worldwide and some other reasons. But so far, all the experts tell us that in the next year we will have a normalization of price inflation again.
Now, the EU and UK are braced for a new round of negotiations in London over the coming days over trade barriers in Northern Ireland. That is after Brussels unveiled a set of proposed adjustments to the trade protocol that would slash customs checks into the territory by half and cut sanitary inspections on many retail goods by 80%. The British say the existing agreements are just unworkable. And the Turkish lira has dropped to a record low against the dollar after President Recep Tayyip Erdogan fired 3 members of the central bank's rate-setting committee in a midnight decree. Bloomberg understands the changes rid the committee of members who disagreed with Erdogan's calls to continue cutting interest rates. Now, that's despite high inflation. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, quite a lot going on in the markets. First of all, look out for some U.S. bank earnings. A little bit later, they start with Bank of America. Again, it will give us a good indication of what we heard from JPMorgan yesterday and whether it's the right way to look at some of the markets. The other big story, and we're all over it, is the Turkish lira at a record low once again. President Erdogan ousting a trio from the central bank rates panel. Again, we've been talking about it all morning. He has some unconventional way of looking at economics. A self-described enemy of interest rates, President Erdogan espouses this theory that reducing interest rates will lead to lower inflation. You can see a Turkish lira at 9.1292. Now, later on in the program, we also hear more from my exclusive interview with Ana Botin, the Santander executive chair, telling me she sees the current inflation spike as temporary. We'll also get more thoughts from Christian Müller-Gleesman of Goldman Sachs. I know we have a couple of viewer questions, smart viewer questions on his building portfolio strategy, so we'll put those questions to Christian. This is Bloomberg. Fed minutes flag imminent start to tapering, while pandemic stimulus in the U.S. could end by mid-2022. CPI prints above 5% again. China feels a price pressure as well. Factory inflation hits a 26-year high. The PBOC governor says inflation is moderate overall. And Ana Botin exclusive, the Santander executive chair, tells us that she sees inflation as temporary, spurred by COVID. More from that interview throughout the hour. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Banco Santander's chair, Ana Botin, says she believes inflation pressures are linked to the pandemic and are transitory. Speaking exclusively to Bloomberg, she urged caution.
Well, there's a lot of talk, and this is linked to the big issue in financial markets today, which is inflation, which is this a temporary issue? And I believe it is, in the sense that, COVID is a one-off, and it sort of created a spike, but US, China already ahead of where they were pre-COVID. Europe will be there in Q1. And so I do think energy is a factor, but hopefully it's part of the broader picture of how do we green the economy at a cost that we can afford and that is fair, and where the cost is borne by everybody in a fair way.
And you have a great snapshot of the world because you have an overview of the emerging markets, of the UK, of Europe, of the US, of Asia. What worries you about what we're living through at the moment economically?
So first, let me say the positive. Okay. We're in a much better place than a year ago. 6% global growth for this year, 4% for next year. That's IMF latest predictions. It's actually pretty good. And so I think that is one thing. The other is, of course, governments, especially in the developed world, were very much, in a timely way, making sure that businesses survive. And so I think those are very positive signals. The other one is, of course, there's been a huge amount of savings. I mean, Spain, for example, in 2020 increased savings by 110 billion. That's almost 10% of GDP. On the risk side, what happens with the excess government debt? What happens when businesses and people are taking off life support? Do they go back to being, in a regular situation and able to cope? Is inflation temporary? Those are the issues we need to tackle.
And we'll hear more from my exclusive interview with Santander's chair, Ana Botin, later on in the program when she gives us her thoughts on the crypto space. Now, Christian Müller-Gleesman from Goldman Sachs is still with us. And Christian, we talked a little bit about inflation. We talked a little bit about your 60-40 strategy. We also have a great viewer question. So I love viewer questions. Thank you so much for sending them in. This person wrote in, Christian, for you, with the bond market being elevated, how do you, Christian, see that affecting cross-asset portfolios with a transitory narrative?
Oh, this is a very good question indeed, and that's something we're wondering a lot about. I mean, once we get away from the stagflation fears, once we get away from the sticky inflation story, which seems to be a lot of a fourth quarter story because you have so many cross currents supporting inflation, oil on the one hand, labor markets reopening and efficiencies, a few kind of lingering COVID reopening effects like used cars, etc. But I think our view from the economic side is that inflation will actually come down, and it will come down quite sharply towards the second half of next year. So bond yields in that situation should possibly come down as well, led by the break-evens, of course, because the break-even inflation for the next 10 years has moved up a lot, especially in places like Europe recently and the UK. So now the big question is, when that inflation comes down, what happens to real yields? Because I mentioned earlier that the most important driver of valuations across assets and a 60-40 portfolio will be the TIPS yield and real yields. And my fear is that as we normalize, we come out of COVID, and this crisis has really pushed real yields to all-time lows, that as we normalize, both inflation comes down and growth kind of starts to kind of normalize to a mid-cycle backdrop, the upward pressure on real yields will continue. And there's another really important factor, which is just the inflation volatility and the macro volatility this cycle has had since the beginning of the recovery, that also should push up back end real yields. So at the margin, I would say that even if the inflation comes down, it will not be a huge relief for valuations across assets or another boost. It will at the margin continue to be a bit of a drag.
Christian, what do you do with gold right now?
It's another really good question. I mean, it's the most directly linked asset to real yields. So you can hear from what I said earlier, there's a few risks there, no? I think it feels like gold has at the margin a lot to lose if real yields move higher. There's two good things here. The first thing is that it's lagged materially the decline in real yields in the summer. So it seems like gold investors have not gotten that excited with the decline in real yields, so they might not get that worried with the increase in real yields, at least initially. And the other thing is the dollar. I think you do have a decent linkage to the dollar, and with the view that in the long run, the dollar will start to kind of take a downward trend again, I think you could also see gold being an interesting asset. But for fourth quarter, being bearish the dollar is very dangerous because the US is the only economy which doesn't seem to have an energy crisis. So at the margin, if the energy crisis intensifies, you could say that the US is a relative winner. And then you don't want to be short the dollar because Europe, as we know, is negatively exposed to these energy prices.
Christian, overall, what are you expecting from the earnings season? I know there's, energy prices, concern about margins being hit. I hear more and more strategists say maybe the banks is a good way to play this. I mean, we'll see what the U.S. banks come out with today. But, maybe the banks are a good way to play this because of this incoming inflation. Like, what are you expecting in terms of earnings crop?
Yeah, it's difficult from here, no? Because I think the last few earnings seasons have been blockbuster. You had big surprises to the upside, driven by cyclicals, by value. And I think the expectations have moved up. And actually, economic forecasts from our team are by now in line with consensus, actually even below consensus for the fourth quarter. So it feels like to surprise to the upside is more difficult. But there's another thing, of course. Levels of growth are very good, but we've had these negative macro surprises. And that means at the margin, we currently are leaning more towards value parts of the market than cyclicals. Right. And banks, they are clearly in the value bucket. I think we do still see the potential for those areas. Both energy and banks are the most prominent value sectors to surprise a bit to the upside because they have so many macro tailwinds that are specific to them. Steeper curves in Europe, of course, we discussed. I think at the margin that should support those banks. And generally, we just feel that there's still a decent amount of longer-term structural pessimism with regards to banks, which allows probably to surprise to the upside for a bit longer, if you know what I mean, both with regards to prices and with regards to earnings estimates.
Christian, what's your take on the UK? So, I mean, there's the energy prices, compounded by also supply chain issues. Do you look at the UK and say, actually, it's apart from some of the other equity markets that we're seeing, or is it part of the same story?
Yeah, the UK is looking a bit scarier maybe on the economic side than other places in the world. I think the UK equity market, as you know, the FTSE 100 is not really closely linked to the UK economy. A large part of the revenue there is outside of the UK. These are international companies, and they actually have a lot of commodity exposure. So you can definitely see the UK equity market in a quite positive light into year end. It's also quite low volatility compared to other markets. So we kind of like that, but we've definitely seen the UK domestic index, like FTSE 250, and we have like baskets linked to the UK economy. They've suffered, and it's a lot related to the fact that obviously inflation levels, both realized and in particular implied, are much higher in the UK, and there's more pressure on the BOE to normalize policy, and that kind of means at the margin the UK domestic exposures, they are a bit more risky into the fourth quarter, because as we said, the central bank tightening is really something that can scare investors.
Christian, thank you so much. Christian Muller-Gleesman there, Goldman Sachs Managing Director for Portfolio Strategy and Asset Allocation, joining us this morning. Now, coming up, a new era for Technicolor. We'll be joined by the chief executive to discuss the motion picture company's turnaround from bankruptcy. More on that shortly. This is Bloomberg.
I think the next big thing, which is already here actually, is crypto. So I think that is it's already happening. We talk a lot about the CBDC, central bank digital currencies. The fact is you already have around 100 billion of stablecoin dollars, US dollar, fiat currency, digital currency in the US today, unregulated outside the system. And so how do we think about that? There's a huge amount of innovation happening, and in an area that is very much systemic. It's about monetary policy and, how that gets managed, whether it's inside or outside the system.
So how do you look at crypto? And actually, do you have to be, as a chief executive chairman, a believer of crypto to be able to have the right products for your customers?
Well, we are sort of a leader in crypto. We issued the first end-to-end bond on the blockchain, which is a technology behind crypto. We have a very strong group, not huge, but strong group on that. And the big thing is, how will central banks want to manage this? Will they manage it themselves? Will they create a framework and tell us how to do it? Will they do nothing? I think they will be working with us, with the banks. And it's also what role we want to play in that value chain, right?
Yeah. And how many customers actually want to buy Bitcoin? Do they come to you, or to your cashier?
They actually do, but we've been quite slow in adopting that because of compliance and regulatory and risk appetite. But we're now getting into it, so we're now either about to offer or already offering crypto ETFs. So being very careful about the know your customer, but being able to offer the product.
Banco Santander, their chair, Ana Botin's thoughts on the crypto space, speaking exclusively to Bloomberg. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. TSMC says it will build a fabrication facility for specialty chips in Japan and plans to begin production there in late 2024. That comes as the world's #1 foundry reported quarterly profit beating expectations as demand for chips stayed robust in the face of worsening supply chain problems. The Taiwanese company has set aside $100 billion to grow output over the next 3 years. Now, finance ministers from the world's biggest economies have endorsed a global tax overhaul. 136 governments had earlier reached a deal over a minimum rate to be set at 15% for corporations. Plans for digital taxes have also been scrapped after the US said they were discriminatory. The stage is now set for G20 leaders to approve the accord at a summit later this month. Sources tell us that Amazon.com is shopping for used long-range Boeing 777s and Airbus A330 cargo planes, more evidence of the company's ambitions to move products from countries like China by itself. The plane models are bigger than Amazon's current fleet of Boeing 767s and would see the e-commerce giant set up a rivalry with UPS and FedEx. And Cathie Wood is joining the slate of Wall Street players hoping US regulators will soon greenlight an ETF tracking Bitcoin futures. The new ETF plans to invest in contracts that trade on commodity exchanges. According to Bloomberg Intelligence, 9 Bitcoin futures ETF applications were being considered by regulators at the beginning of this month. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now, it's been a year since Technicolor shed roughly $770 million in debt as part of a $1.4 billion restructuring plan. Now, the France-based motion picture company has been boldly pursuing its turnaround plan under new leadership from Richard Mote. He has pulled the company out of bankruptcy, investing heavily in AI and AR technologies, and expanding partnerships with Netflix, Amazon, and Disney+. Well, we're delighted to be joined by Richard Mote, the chief executive of Technicolor. Welcome to Bloomberg Surveillance, and thank you so much for coming in the studio. Richard,
well, thank you for having me on.
I have a million questions. First of all, so you took this company, you turned it around, and now you're trying to areas of growth. There's something called the metaverse. And actually, maybe a lot of boomers watching us don't quite know what the metaverse is compared to the younger millennials. Is this where you see the main area of growth for Technicolor going forward?
Well, the film industry is coming roaring back during 2021 after a very quiet 2020 because of the pandemic. And we're taking advantage of that in all of the aspects of work which we do for the Hollywood studios and for the big streaming and episodic players like Netflix, Amazon and Apple. But you're right that the metaverse is a coming element of the work that we do. And we think we're going to be a central element of bringing that to life because we can create characters, we can create avatars, virtual environments, all of the things which will be necessary to bring the metaverse to life. And just to give you one example of what we've done recently, we worked with a firm called Riot Games to produce a virtual concert of a virtual band called Technicolor, which has 7 members, none of whom are real. And they did their second concert recently in a sort of vast virtual arena space. And we did everything end to end for that.
So, Richard, overall, what was the problem with Technicolor in the past? I guess the million-dollar question is, why would people use Technicolor to use some of these characters instead of doing it in-house?
Well, I think that we combine getting the best possible artists using the best possible technology. We spend an enormous amount every year on research and development into new software, cutting-edge software, and that produces the best visual effects of all types for the Hollywood studios and for the streamers and, as you say, for the creation of the metaverse and indeed for big brands and advertisers around the world because we're the #1 supplier of visual effects to the advertising industry as well. So people know that we do things on budget, on time and very high quality, and that's what they like to get from us.
So, Richard, what was your biggest challenge when you take over the company and you have to, really turn it around? I remember at the time we were talking about Technicolor, people were worried, saying maybe this is a Kodak moment for the company. So, is it reputational? Is it trying to get new customers? Like, how did you manage that?
Well, I took over almost exactly 2 years ago, and that was just before the pandemic struck, and nobody knew about it then, obviously. So we had to re-engineer the balance sheet, and as you say, we reduced our debt significantly. We got $420 million of new cash into the business, and that put us in a really strong position looking forwards to the future from a financial point of view. But then we also had to do a transformation of the business to take a significant amount of the OPEX out, more than $300 million by the end of this year. And in addition to that, we wanted to refocus on the key areas of growth, which obviously is visual effects, the flagship area of the business. But we also saw fantastic growth from our connected home division, which makes broadband gateways and set-top boxes, because people locked down wanted to get better broadband and Wi-Fi experience, and we were supplying high-end products. And also, strangely, in the DVD division, where we're the largest producer of DVDs in the world, we actually saw huge demand for back catalogue titles, which we hadn't seen previously.
But your biggest challenge was what, one of reputation?
I think we always had an excellent reputation in the VFX division. So we had to restore our reputation, I think, with investors and with the general investing community. That was the biggest challenge. But the re-engineering was done in 2020, and we're looking forward to the future with some real confidence now.
So I hope to speak to you before 5 years, but if I speak to you in 5 years, how much of your revenue will actually come from films, TV series, and how much of it will come this new world of gaming and metaverse?
Well, we're getting about 50% of our revenues from the connected home division, and about 25% from film and 25% from DVD. But that's the film side of it is growing really substantially. And a lot of that is coming from the growth from the episodic and streaming players, because they want to get and keep more and more subscribers. And in order to do that, they need to improve the excitement which they provide in terms of the content, to provide a hook. And so therefore they're spending more and more money on visual effects, and that's playing into huge growth for us.
But I thought, Richard, that everything was done in-house. I mean, you're almost a middleman, right? Trying to private services from some of these content producers, and they're snubbing a lot of the Hollywood studios. They're trying to do it in-house, like Netflix and Amazon. Do you think eventually you'll be bought out?
I think that we've got a crucial role to play. I mean, we don't produce original content. We do work for the Hollywood studios, we do work for the streamers, we do work for big brands like Nike and Apple. So we don't create that original content, but we do, as I say, do extremely high quality work, which we believe is better quality than anybody else in the business can do it. And as a result of that, we've got more than 20% worldwide market share. And that, I think, is going to secure our position and secure our growth out into the future. So in 5 years' time, if you were talking to me then, I think that film would have become the predominant area of our business, and we hope to see continued growth beyond that.
Excellent. Richard, thank you so much for coming on today. Richard Mote there, the Chief Executive of Technicolor, joining us this morning. Now, this is what the markets are doing. A lot of focus, of course, on Turkish lira. I know it was one of our main stories. This is after we saw 3 firings, actually, from the central bank, from President Erdogan. So we're seeing Turkish lira at a record low. Overall, we're waiting for earnings. A lot of U.S. banks actually will report later on, and we're seeing a bit of a lift to some of these markets. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's take a look at some of the things to watch out for today. At 10:30 a.m. UK time, the EIA crude oil inventory report is due to be released. Then 1:30 p.m. UK time, we also have some U.S. data, including initial jobless claims and PPI, followed a little bit later by a number of big U.S. bank third quarter earnings, including Bank of America, Wells Fargo, Morgan Stanley, and Citigroup. Of course, we'll be monitoring all of those third quarter earnings from bank chiefs throughout the day, beginning with Morgan Stanley Chief Executive James Gorman, who's due to speak at around 3:30 p.m. UK time. Then the TD Bank Chief Executive Gregory Braca at 7 p.m. and Bank of America Chief Executive Brian Moynihan at 8 p.m. Wells Fargo Chief Financial Officer speaks to us at 9 p.m. as well. Now, it's also a busy day for a number of Fed policymakers. I told you this Thursday, just stay at home and watch Bloomberg, because we have a lot of news, many taking part in discussion across the country. The Atlanta Fed President Raphael Bostic kicks it all off as he takes part in a virtual panel, Inclusive Growth, hosted by the Aspen Institute at 10 a.m. UK time, followed by New York Fed Executive Vice President Loris Logan at 12 p.m. Then the Richmond Fed President Thomas Barkin talks at 1 p.m. At the same time, it's San Francisco Fed President, finally Philadelphia Fed President Patrick Harker at 6 p.m. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller joins me at Berlin. Kailey Leinz will be in New York. We have you covered when it comes to U.S. bank earnings. We'll be speaking to our Sonali Bazek. We also have the very latest on the Turkish lira at a new record low after we had news overnight by a midnight decree by President Erdogan. This is Bloomberg.
I'm very concerned that the chairman of the Federal Reserve has not taken on board the real risks associated with climate change.
Going green will have a cost, but there's also a huge opportunity for business and investment.
We have a generation of central bankers who are defining themselves by their wokeness.
This is Bloomberg Surveillance Early Edition with Francine Lacqua, Matt Miller, and Kailey Leinz.
Well, it's 10 a.m. here in London, 11 a.m. Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Thursday, October 14th. Our top stories today. The market's magic words. Investors are constantly hearing inflation and supply chain as executives at large companies discuss their prospects. More earnings are on tap today. Erdogan's midnight makeover, while the Turkish president fires policymakers at the central bank who were opposed to cutting interest rates. The lira slides, and power failure. 2 more energy suppliers in the UK go out of business, victims of unprecedented volatility in the natural gas market. So we have a lot of news today. We also have a lot of Fed speakers later on throughout the day. Kailey, if you look at the markets, sure, we worry about inflation, but the traders actually focus on earnings.
Yeah, absolutely. And we get a lot more of them today, Francine. 4 more big banks will be reporting before the opening bell here in the U.S. So we're really just waiting and watching for that. Now, as for what the picture looked like in the Asian session, there was a lot of green. If you look at GMM Go on the Bloomberg terminal, you see green across stocks, currencies, bonds, really a broad day of gains in Asia. When it comes to the equity market specifically, Hong Kong was closed for trading today, but stocks were up about 1.5% in Japan and South Korea, though they did fall in China. And of course, that is after the inflation data we got out of China overnight. Factory gate inflation hitting its highest in 26 years. Producer prices up 10.7% year on year. And you can blame a lot of that on what we've seen in the commodity complex. Coal futures, for example, hitting another record high today. And now it's spread even to zinc, with futures hitting up 8% at one point because the power shortage is leading a lot of people to think that supply and production may be lower. In other asset classes, I would point to bonds in Australia. You had a September jobs report that showed a bigger drop in employment than expected. So we saw the 10-year yield coming in 6 basis points in that country. And then I would just point out in foreign exchange, the Japanese yen is your biggest underperformer in Asia and in G10. It is weaker against the dollar by about 0.2%. Now, here in the U.S., we are digesting yesterday's inflation data, those Fed minutes we got at 2 p.m. Eastern time on Wednesday, and then, of course, waiting for earnings. But as we await those, stocks are in positive territory, or at least futures are. S&P E-minis up about 0.6%, 0.7%. In the bond market, we are coming in just a touch after declining 7.5 basis points over the last 2 days. The 10-year Treasury yield now sitting at 1.53%. It is a weaker dollar story for the second day, and that in part may be what's lifting crude. But, of course, the power crunch globally is aiding crude as well. WTI up 1 percentage point this morning. We are north of $81 a barrel, Matt.
Yeah, Kailey, the power crunch front and center here. And I'm glad you included zinc as well in your rundown. I noticed that on my GMM this morning. It's in a black box, which means it's moving 3 standard deviations or more away from its 30-day average. So that's one of the reasons that we have the miners doing so well here in Europe. You see a lot of green on your screen here. Miners and tech companies really leading the way in terms of the equities rally. Right now we're up almost 1% across major European indexes. And then we see big gains in commodities. As I said, that energy crunch is front and center. We see big gains in Brent crude, the global benchmark. We see big gains, even bigger gains in nat gas because of the UK nat gas story, which seems never ending, although it's only been, I guess, a couple of months now. And then look at the second row there. You can see the US dollar, Turkish lira, an all-time low. You can now buy more than 9.1 lira. Are we headed to double digits? It's a really interesting story that I think traders are watching very closely, because this is a currency pair that gets traded a lot. It's a big deal in the FX world. And it's also interesting that Erdogan seems to think cutting rates will help tame inflation, which is pretty much the opposite of what you learned, Francine, in Econ 101.
I know, it's been quite, interesting actually reading some of his comments. He's a self-described enemy of interest rates, and he does espouse this unconventional theory, as Matt Miller was saying, that actually reducing interest rates will lead to lower inflation. Now look at what's ahead today. It's another day of U.S. bank earnings with Bank of America, Morgan Stanley, Wells Fargo, and Citigroup reporting. At 11 a.m. New York time, watch the EIA crude oil inventory report, which comes out amid the energy crunch and a warning that U.S. consumers are set for an expensive winter. The U.S. FDA meets to discuss Moderna and Pfizer booster COVID shots, plus a slew of Fed speakers. Bullard, Bostic, Barkin, and others are set to take part in discussions across the day. Now let's get straight to that Turkish lira story. The Turkish president firing 3 monetary policymakers wary of cutting interest rates. This comes against a backdrop of a weakening lira already, which fell to a record low once again against the dollar. So let's get more with Bloomberg's Onur Ant. Onur, this could surprise many, but we know that President Erdogan does not believe in interest rates. So will he just have much more influence now on central bank policy?
Yeah, he surely does he surely has more influence now than he did about 13 hours ago after he fired 3 members of the rate setting committee of the central bank. We have reason to believe, our sources tell us that some of those people were opposed to Erdogan's desire for continuation of interest rate cuts after last month's unexpected cut to the benchmark rate, even as inflation was accelerating, Francine.
By the way, owner President Erdogan, he has been pressuring the central bank for some time to cut rates. Could this signal that there are now more cuts to come?
We do think that last night's firing do pave the way for possibly more rate cuts by the Turkish central bank. And already some of the analysts are have been revising their expectations for the interest rate path going forward. One of the Istanbul-based economists at HSBC Portfolio Management, for instance, just changed his call for a 50 basis points rate cut from a 50 basis point rate cut to 100 basis point rate cut for next Thursday's decision by the Turkish central bank.
Onur, thank you so much. Onur on there from Istanbul. Now, the energy crunch has closed 2 more UK energy providers, Pure Planet and Colorado Energy, closing, affecting 250,000 customers. In total, 12 energy companies have closed so far since August, affecting 2 million households. Well, let's get the latest with Bloomberg's Danny Berger. Danny, it doesn't look like it's going to get better as well.
Yeah, this is the problem. The energy crisis isn't easing, Francine. Now that we have 2 more providers closing, I should say Pure Planet, this is a BP-backed one. So these are significant. These aren't small, no-name type energy providers. And as you said, it's now 2 million people who have had to switch providers. That's the total of all the 12 that we've seen collapse. Now, the issue is that this could indeed add to already very high UK inflation, which has implications for the BOE as well. Now, there is a limit to how much customers will have to pay if they switch to different providers because of government caps, because of fixed contracts. But this is also part of the problem. These large providers who all of a sudden have more customers coming on, they are already stretched. And for the small providers, they are having to go into the spot market, buy these sky-high prices because they are not fully hedged. So if you're not fully hedged, you have to go into the market, you have to pay more, and you can't pass that on to the customer because of some of these contracts and caps. This does mean that we could see more companies go the way of these 12 collapsing. It's certainly a warning we've heard from the UK Business Secretary.
Well, call it President Putin to the rescue, Danny, because he says Russia is ready to deliver all the natural gas that Europe and the UK need. What's in it for him?
Well, Kailey, it's a great question. People familiar have told Bloomberg that Putin is hoping to press the EU to rewrite some of its gas market rules. And so he was speaking yesterday, the comments you mentioned, at a summit about Russia energy, and he used the opportunity to criticize the EU. So you get hints of what he's aiming to do. He said the European gas market does not look well and balanced enough to be stable. So really what he wants to do is to press the EU to go in and buy long-term contracts with Gazprom rather than short-term spot prices. This is better for Gazprom. Long contracts means more stability, less downside risk, and he wants to push through a faster approval of the very controversial Nord Stream 2. So him stepping in, acting as a savior type, it could be a big opportunity to get these reforms that he wants to see done in the EU.
Danny, thank you so much. No free lunch, I think, is what we learned from a young age. Now over to Washington. President Biden says he wants to break a logjam at U.S. ports and stave off holiday season shortages and delays. Now, he announced yesterday that the Port of Los Angeles will begin operating around the clock.
This is the first key step toward moving our entire freight, transportation, and logistical supply chain nationwide to a 24/7 system.
Let's get straight to Jack Fitzpatrick, Bloomberg government reporter, joining us from Washington. Jack, what can the U.S. actually do to, get rid of this logjam?
It's a matter of the federal government trying to work with companies, but these are private companies' decisions that they're making. The announcement yesterday, late the day before, that the president made about 24/7 operations at the Port of Los Angeles and other similar expansions of schedules by major companies like Walmart and Samsung and Target and UPS were more about the president I don't know if it's necessarily bullying, but it's sort of the use of the bully pulpit and trying to be a broker who works with private companies to get them to move things along. Really, at this point, there's not an influx of federal resources or anything along those lines, but this is a matter of the president trying to negotiate some private sector solutions just for an expansion of schedules and get things moving, particularly at night when they previously weren't.
Yeah, and Jack, how much harder do these supply chain issues make the job of the administration trying to push back on the idea that its policies have caused higher inflation?
Very difficult. Politically, the conversation about inflation, if you are on Capitol Hill talking to lawmakers, does not tend to get into the nuance of how much of it comes from supply side issues versus demand side issues. The 2022 midterm view of this is that Republicans are probably going to hit Democrats on inflation and tie that to their legislative agenda, including the stimulus payments, which are not irrelevant to it, but it really doesn't get into these more technical issues of supply chain issues. In fact, that's why you heard in his speech the president kind of try to lay out in plain English and say, you may have heard of something called the supply chain. That's a difficult message to send, though, so it's a politically difficult one for the president.
It's all about perception. Jack Fitzpatrick of Bloomberg Government in Washington, thank you so much. And now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. And of course, we were just talking with Danny Berger about the energy crunch that's happening not just in the UK, but globally. That is actually giving a lift to some names, including Kinder Morgan, which actually could be higher for a 6th day in a row today. It, of course, is a pipeline operator, and it is up about 3% before the bell. Same goes for Devon Energy and really energy stocks across the board, E&Ps in particular when it comes to oil companies. Devon is up 2% in pre-market trading, and this is a stock up 146% year to date. It is the best performer, actually, in the S&P 500 Energy Index in 2021 thus far. One over to the downside, though, is Wayfair, of course, the online home furnishing retailer. It got downgraded at Morgan Stanley. The analyst putting a $195 price target on the stock. That's downside of about 17% from yesterday's close. This morning, it's down the better part of 3%, trading right around $228 a share, Francine.
Kailey, a lot going on in the markets. Coming up, it's a busy morning also for banks. Bank of America, Morgan Stanley, Wells Fargo, Citi, all reporting. So stay with Bloomberg for full coverage of those results with interviews with the chief executives of Morgan Stanley, Bank of America, the Wells Fargo chief financial officer as well. This is Bloomberg. We also have, of course, an exclusive with Ana Botin coming up, the Santander chair. She weighs in on the inflation debate, plus the investor all-stars. Some of the biggest names in private equity and Europe's most promising tech startups are meeting in London today. We'll be speaking to the chief executive of the fintech startup Molly and tech investor Carolina Brochado of EQT this hour. This is Bloomberg.
Well, you know, there's a lot of talk, and this is linked to the big issue in financial markets today, which is inflation, which is this a temporary issue? And I believe it is, in the sense that, you know, COVID is a one-off, and it sort of created a spike.
You can have good growth with some inflation, and that, you know, that's okay. I think that people are always focusing too much on, you know, immediate concerns. You know, if you have inflation at 4% or 5%, we're still going to open deposit accounts, checking accounts, and grow our business.
That was Santander Chairman Ana Botin and JPMorgan CEO Jamie Dimon speaking with Bloomberg earlier this week. And it's another busy day for U.S. bank earnings with Bank of America, Morgan Stanley, Wells Fargo, and Citigroup all reporting this morning. Shonali Bosick, our Bloomberg Wall Street reporter, is going to be very, very busy. So Shonali, JPMorgan was first out of the gate. Results pretty solid. What kind of bar did they set for these four this morning?
A very high one, because we know that even with blowing through the roof in investment banking figures, the loan growth is still elusive. And so for Bank of America, the bar is quite high, Kailey, because analysts expect them to actually increase revenue from the prior quarter rather than decrease as we see at the other banks. That will all depend on the loan growth, right? Investment banking, we know, is doing well. They have to meet expectations, but they also have to show that net interest income is growing. For Citigroup, the largest card issuer, that's also going to be a big question mark, the card business in particular. And that was a particular weak spot for JPMorgan, where you saw the rest of the card issuers in the stock market also start to sell off yesterday.
So, Sonali, good morning from London. Wells Fargo, I guess we're expecting and hoping to have more, update on some of the regulatory issues. And then if you look at Morgan Stanley, it's really all about the investment bank.
Yeah, that's absolutely true. For Wells Fargo and for Citigroup, we want updates on regulatory issues. For Wells Fargo, they've been trading a little better in the stock market. We know Citigroup is still below their price to book value. So the bar is high for them to start showing improvements on Jane Fraser's strategy, though we know it's still early. For Morgan Stanley, where is the bar high? It's for equities trading. Citigroup, Goldman, Morgan Stanley among the top equity underwriters in the world right now, so that should flow through to equity underwriting. But as you know from yesterday, JPMorgan also set the bar quite high there, not only beating, but posting more in revenue than analysts expected over at Morgan Stanley, the biggest equity shop, and Goldman Sachs. So the market share will be a question.
My first thought yesterday, talking with Paul Sweeney on our Bloomberg radio show, how much are these bankers going to get paid? If they do so well in businesses like M&A and businesses like FICC trading and equity trading, they're going to expect big bonuses.
Yeah, they certainly are. We heard JPMorgan yesterday already say that expect expenses to go up because they do pay for performance. So if you're having a good year, you should be getting paid for it. Remember, we're also in the middle of what Bank of America CEO Brian Moynihan has called a talent war. So there is this recognition that it's not just pay for performance, but pay to keep your staff, and we are seeing it at every level. At the end of the day, the expense guidance will be interesting. These firms are also spending on acquisitions, Matt, as well as technology. So there's a lot of pressure on margins at the end of the day into next year.
Sonali, thanks so much. Sonali Basak there with the very latest on these Wall Street titans reporting today. Stay tuned for interviews throughout the day with the Morgan Stanley Chief Executive, the Bank of America Chief Executive, and the Chief Financial Officer of Wells Fargo.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz in New York with Francine Lacqua in London and Matt Miller in Berlin. Now let's get the first word news. And last month, Federal Reserve officials agreed they could start reducing emergency support for the economy in mid-November or mid-December. Minutes of the policymakers' meeting showed that there was increasing concern over inflation. Most participants saw inflation risk weighed to the upside. They also discussed whether labor supply would bounce back to 2019 levels. President Biden heads to global climate talks at the end of the month, weakened by infighting at home. He has embraced climate action as no other U.S. president has, promising to cut carbon from grids and shifting to electric cars. But U.S. negotiators at the Glasgow summit may have nothing to show other than promises of action. A down payment and funding to help poor countries fight climate change is unlikely to clear Congress this month. In China, factoring inflation grew at the fastest rate last month in almost 26 years. The producer price index rose 10.7% from a year earlier. Coal prices and other commodity costs soared. That could add to inflation pressure if local businesses start passing on higher costs to customers. And 8 out of 10 British companies struggled to find workers last month, even though many are increasing wages. A survey by the British Chambers of Commerce found that labor shortages are getting worse. It forecasts that consumers will see further reductions in goods and services. So basically, Matt, there is a labor shortage everywhere, and while we were expecting it to improve, it's just not getting better.
Yeah, absolutely. This is one of the things I asked myself when I look at what's going on in Washington. How are they going to fix the supply chain issues? Does it matter if you open a port at night if you can't hire anybody to work there? You've got to fix the labor and the infrastructure problems before you're going to get the supply chain back on track, or the demand has to come back down.
Yeah, I think the UK is also quite specific because of a number of reasons. We have estimations that 100,000 European workers left because of the pandemic. So it's partly COVID, it's partly Brexit, and we see a shortage across the board, which you're right, Kailey, is symptomatic of things that we're seeing around the world, but just so much more in the UK because of the quirks of needing visas. So we have, for example, the UK government saying, look, I need 5,000 drivers, I need 5,000 poultry farmers, and they can come from October to, I think, January. It's like a 3-month special visa, and they're trying to recruit right now.
Well, and it's an interesting question. We already have inflationary pressures in the UK coming from the power crunch you were seeing and higher energy prices that people have to pay. When does that start to be felt more in wages because of the labor shortage? As we said, people are already raising wages to a certain extent, and it's not bringing more people in the door. So do you have to go even further? And does that start to create more inflationary pressure that central banks have to really kind of get a grip on?
Yeah, that's $1 million question. Do you pay people more? Do you even have the staff, or are they actually in Europe or elsewhere? And again, the energy crisis is also because we didn't have enough drivers in the first place to bring them to the gas pumps. So it's like, frankly, we're lucky we're not in policy to try and figure all of this out, Matt.
Yeah, well, I mean, of course, you can't not talk about Brexit. That's really the specific problem to the UK that exacerbates the problems we're seeing in the rest of the world.
Yeah, coming up, we'll talk about supply chains. We'll talk about maybe truck drivers with David Stubbs, head of investment strategy at JPMorgan Private Bank. This is Bloomberg. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua here in London, Matt Miller in Berlin, Kailey Leinz in New York. Matt, we're talking about supply chains, then we got distracted by donuts. But never mind, if you look at the supply chains, it's kind of undermining a lot of the recovery, but actually traders don't seem to care too much today.
Yeah, the supply chain and the labor shortage issues, they kind of go hand in hand. These are the big problems, when you talk to especially small business owners. I talked to the NFIB's chief economist the other day, which is the U.S. National Federation of Independent Businesses. She said there's no end in sight for the supply chain and labor shortages, and that's a real problem for the economy. This is part of what's leading so many people to use the word stagflation.
Yeah, stagflation. But Kailey, markets are looking at the inflation numbers. Maybe at the margin they're worrying about tapering, but they're pretty strong today.
Yeah, maybe focused a bit more on earnings than on the inflation story, considering we do have 4 more big banks reporting over the course of the morning before the opening bell here in the U.S. Right now, equity futures are positive in the U.S. and stocks are positive as well in Europe. The Stoxx 600 actually up about 0.9%, being led by basic resources. In the bond market, we go nowhere on the U.S. 10-year Treasury yield. We are steady right at 153 after coming in 7.5 basis points over the last 2 days. And then feeding into that basic resources are higher in Europe is the fact that commodity prices are really higher across the board. You have WTI crude above $81 a barrel, and you're getting a lift broadly for some of the metals as well, and that has driven the Bloomberg Commodities Index up about 1% at its highest going back to May of 2015. No surprise then that you're seeing energy and material stocks getting a lift in pre-market trading. The likes of Diamondback, Devon Energy, Occidental Petroleum all up more than 2%, as is Freeport-McMoRan, which of course is a material stock, Francine.
Yeah, we'll have plenty more, of course, on some of those earnings. Joining us is David Stubbs, head of investment strategy at JPMorgan. David, good morning. Nice to see you back in the studio.
Yeah.
When you look at inflation pressures, when you look at some of the monetary policy mistake that we could be looking at, is the more immediate effect actually on earnings and margin squeezed?
At the moment, we think that most parts of the equity market are going to be able to protect their margins, because I think there's very good cost control in other areas. And I think also there's elements of what we think is a continued productivity surge in many places. We saw, Francine, during the COVID pandemic, the necessity to invest in a lot of digital tools. And I think that has laid the foundation for many companies now to support this expansion whilst protecting margins, even though some cost pressures are rising.
I was going to say, the energy prices, I mean, how much does that hurt companies across the world?
Not nearly as much as you might have thought, right? The energy intensity of GDP, how much energy you need to use to create a dollar of GDP, a euro, a pound of GDP, has shrunken dramatically, more than 70% since the 1970s, right? That's one of the reasons why we're not going to see a very significant pass-through to headline inflation from the energy move too much. And of course, we know that if you look further out, the Bank of England, ECB, the Fed are all on record saying that a move in energy prices is ultimately deflationary. Why? Because it damages real wages, it sucks money out of everything else. You've got to pay for the gas, you can't buy anything else. That's why I wouldn't expect central banks to react too greatly to what should be a temporary move up in energy prices.
Well, we do see, though, markets pulling forward expectations for hikes, right? So does this give you an edge, David? Does this give you an opportunity?
Matt, I think the reason that you've seen markets pull things forward is actually confusion over the labour market, right? So what we have here, I think, maybe the biggest question in my mind for global economists is how much of this clear tightness you see in parts of the labour market is temporary, is artificial, because of COVID disruptions, because of lack of vaccines, because of lack of confidence, because of any kind of short-term removal from the labour market because people's savings are very high. All those things should go away. But if there's something else going on, some kind of major structural change, which is not clear what would cause that, which would remove big chunks of the labour market, and most of the people who've left the labour market are either very young or at the older age of the workforce, then that's going to change the calculus for central banks on how tight they can run the labour markets, how hot they can run their economies. That's the big question there. Matt. And until we see evidence of the labour force really starting to be boosted again and these people come back in, central banks are going to be questioning how far they can go.
Right. We may have to see wages continue to rise. As we were just talking about the UK, which is, has its own unique, some would say self-inflicted problems due to Brexit. But in the Western world, you're seeing everybody raise wages to try and bring people back to work. Are we going to see wages continue to beat expectations?
Look, I think for the next couple of quarters, absolutely the wage dynamics are going to be very strong because, as I said, you've seen labour supply shrink for a number of reasons during the pandemic. It's a little bit of a waiting game now for those people to re-enter the labour market. Obviously, higher wages will be a big part of that. I think there's also a battle for the future of work going on. There's a desire now for increased flexibility, increased benefits. I think it's kind of changed the perception of what work should be for large parts of the labour force, especially in the West. As that battle goes through, I think eventually you will see employers adjust. Not just on wages, but on other characteristics. And then these people will come back into the labour force. That will ease the pressure on wages as we move through 22.
Well, we've obviously seen wages going up, at least at the junior level, at a lot of the big banks because there's a real competition for talent out there. That's basically just a way of me getting to the fact that we're in the middle of bank earnings now, David. Would you be a buyer of financials here?
I think we still like where the financials are. Yes, we see a modest move higher in interest rates still coming. We know the strength of the balance sheets. We know the capital return story here. It's not just about dividends. It's about the very aggressive buyback plans by some of the large banks, for sure. But there's a limit to how far the reopening and cyclical trade is going to go. We're, I think, probably near the end of it than we are at the beginning. We might be taking off some of our cyclical recommendations as we move into the new year. But certainly for yield-seeking investors, absolutely, financials are going to be a big part of their portfolio. And I think you have to look at financials now in the context of the challenge from fintech and the fact that some of these fintech companies are going to be able to take significant market share from certain types of banking opportunities. And that leads to some parts of the financials being vulnerable. That's why I think selection here is going to be very key if you're looking for a multi-year hold on some financials. Yeah.
David, thanks so much. David Stubbs, their head of investment strategy at JPMorgan. Now, coming up, we'll speak to the chief executive of European payment service provider Molly. He joins us live from the Investor All-Stars Conference. Our Tom McKenzie will be bringing us that interview. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, Matt Miller in Berlin, Kailey Leinz in New York. Now, the Investor All-Stars Conference brings together the biggest names in private equity with Europe's most promising technology startups. Joining us now from the conference is Bloomberg's Tom McKenzie, who joins us with the chief executive of a fintech firm. Tom, take it away.
Yeah, Francine, thank you very much indeed. Very pleased to say that I'm joined by the CEO of Molly, Shane Hapatch. Molly is one of the most exciting tech companies in Europe, frankly, in terms of the payments and processing of payments, rivaling the likes of checkout.com and Stripe, backed by Blackstone, the valuation of about $6.5 billion. Shane, thank you for joining us before this conference here in London. Give us an update on the business in terms of the merchants. You service small, medium-sized businesses across the European space in terms of payments and ensuring that they have the software and technology that's needed. Where do you stand in terms of the numbers of merchants that you have on your platform and the daily additions that you're seeing?
Sure. We have about 180,000 active customers today, so
that's a customer that's done a payment at some point in the course of the last year. We have about 400 or 500 customers signing up every single day, around 4,000 or 5,000 that become active in any given month. So still a huge tailwind. We're only in 5 countries as we speak, but we have a big plan and big ambition to grow beyond those borders.
And your business, your sector was one of those areas that was really turbocharged by the impacts of the pandemic. Are you still seeing that demand? Is that starting to ebb off at all, or is it remaining sticky?
Sure. I mean, I think there was a few people that pivoted very, very hard, right? So if you were a business that had absolutely no online strategy and you needed to engineer pickup and takeaway, or you had a restaurant and you needed to offer food delivery and so on and so forth. So you saw some really turbo prop customers signing up every single day, new business models, and some of that's ebbed off, but you do see some permanent changes in behavior. I think if you were the type that shopped in a supermarket and were forced to order your groceries online, I think some of those habits are now ingrained, I think, more and more. And so we've seen some growth just persist in some categories where people's buying habits have been permanently shifted due to the pandemic.
And you talked about that international footprint. I know that Asia is part of the focus for you as well as other parts of Europe. What are the priority countries right now in terms of expansion for Molly?
I mean, I think we have a lot to do for our existing customers. We're expanding in Germany, we're expanding in France. You know, we're in Belgium and the Netherlands. We're also going to enter the UK next year. So that's quite a big to do for us, especially if you want to make the product really sticky and do a really good job in hyper-localizing it, which is part of our value proposition. I think like all businesses, we dream of being global someday, so the product market fit definitely works in other parts of the world, so we're going to start to look further afield throughout the course of 2022.
Okay, so build out that footprint in Europe primarily, countries like Germany, but the US at some point, is that presumably a tantalizing proposition? Is it realistic?
Yeah, I mean, it's a huge market, right? It's my home market. I grew up there. It's very well served, I think, compared to certain other parts of the world, and very competitive. So, you know, we think our right to compete and win still has us focusing on Europe for the foreseeable future. But like all companies, you know, we want to be truly global. Eventually, at some point, you know, we'll have to make sure that we cater for every need, including where customers want us to be.
What themes are you seeing within the e-commerce space at this moment in time that are worth highlighting?
I mean, I think in general, like e-commerce has always been attractive. I mean, it's had many, many years of compound growth. I always think people are astonished by a couple of key stats. You know, one is that everyone assumes that about half the business is online, and in reality, in most European countries, it's sub 10, or maybe 10 to 15%.
Still sub 10?
Still sub 10, yeah. In the Netherlands, about 9%. The rest is retail. So, you know, we still have tremendous headwind, and you'll just see many years of digital substitution, as we call it. I think the other bit is fragmentation. So in the payment space, most people assume, you know, that some of these, the sexiest names out there, you know, some of the top 5 players in terms of global volume, but really about half the business is still held by 10 companies globally, and the other half is 5,000. You know, so we're in the 5,000, and we aim to be in the 10. And that means, you know, over time, the fragmentation will ultimately consolidate as more and more people just do a better job servicing a broader spectrum of customers.
Okay, so consolidation.
Yeah.
Does that start now? Are you starting to see it? Are you going to be involved? What are you looking at in terms of acquisitions?
There's been a lot of M&A and other activity, a lot of partnership too. So, you know, payments is one of those funny industries where your competitors might also be your customers, your distribution partners. So we all kind of cooperate in this big mix in order to try to get to the outcome. But consolidation will continue to play out, I think. In the long run, you know, the world doesn't need 10,000 payment companies, but it's not part of our strategy. We have a ton of headroom in our core market, and we're on a kind of organic build strategy, but you know, you never know. Like, many things, you have to talk to everybody. You have to make sure you understand what's going on.
So organic growth for the moment is a priority rather than acquisitions?
That's right. Yeah.
Okay, because you raised about $800 million in June, I believe.
We did, yeah.
Valuation of about $6.5 billion.
That's right.
And the priority for spending that cash?
Like anything, it starts with great people. So we're trying to build a world-class team. Most of the things that we need to do for clients are product and engineering led. So we're a product-led company, and we want to continue to be so. And you know, like everything, the investment and everything from cybersecurity to the latest technology to making a great web experience, you know, it's all capital intensive. So we want to make sure that we do a great job for our customers.
Okay, Shane, before I let you go, I've got to ask about IPO plans. How are you thinking about exiting from this business? Is an IPO a prospect in the next, say, 12 to 24 months for Molly?
Yeah, I mean, it's not the end goal of the company today. Right now, we have a great amount of work to do for our existing customers. I've been here for 6 months, so although that would be a phenomenal outcome in terms of time motion study, I think we're mainly focused on building the business. And you know, if that's the right outcome for the company at some point, so be it. But I was fond of saying, our customers don't necessarily benefit from us being a public business. They're quite happy for us to focus on delivery for them, and that's what we're going to do over the next 12 months.
Okay, so not rushing towards that IPO. The business was set up in 2004. You took over the helm as CEO 6 months ago. Shane Hapatch, thank you very much indeed. Guys, back to you.
Thank you so much. Bloomberg's Tom McKenzie there on our guest, Shane Hapatch from Moly. Now, coming up, Tom will be back with tech investor Kailey Brochado of EQT Partners from the Investor All-Stars Conference in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London, Matt Miller in Berlin, Kailey Leinz in New York. Now let's get back to the Investor All-Stars Conference, where Bloomberg's Tom McKenzie is joined by another guest. Hi, Tom.
Hi, Francine. So a couple of minutes ago, we were speaking to one of the leading startups here in Europe. Now we're going to be speaking to one of the leading VCs and the partner at EQT, which is Europe's largest listed private equity company, Kailey Brochado. Make sure I get the name and the pronunciation correct. Thank you very much indeed, partner at EQT, formerly at Atomico, formerly at SoftBank in the Vision Fund there. I want to get your views to start with on what we're seeing in terms of VC funding for startups in Europe. It's been a dynamo of a year. At the first half, we saw about 50 billion euros pumped into startups across Europe from VCs. Do you think that momentum sustains itself? Are we at healthy levels at this point?
No, it's super interesting. And having been in Europe now in tech for 9 years, we've seen the capital invested in technology companies in Europe continuing to increase. But we are currently at the most rapid pace. So we're on track to hit 100 billion for the year from the 50, and that would have been 140%, I think, growth year over year in terms of capital invested in Europe.
And that's above the US and above Asia, is that right? I mean,
yes, that's right,
number.
in terms of growth.
Yeah.
But I think, historically, Europe had been very underfunded versus the US and Asia. When we first looked at it, when I was at Atomico in 2014, a Series A founder in Europe had 14 times less capital available to them than a Series A founder in the US. And so now that gap is narrowing, and more talent comes into the ecosystem, sees success, breeds success, and so you see the flywheel really spinning in Europe. So we expect, to answer your question, that we'll see more companies get to growth stage and get to greater and greater market caps as well.
Are you concerned at all about valuations with this amount of liquidity and this amount of funding being pumped into the startup scene here? Are valuations starting to look a little frothy?
Yeah, we always keep an eye, and it's hard because, some people have been saying that valuations have been high for 5 years.
Okay.
And so of course, you always look at the historical averages and whatnot. What we try to do at EQT, we're very thematic investors, is we try to understand the market and the trends, and how big an outcome can be, and whether we can make a return investing now or not. And I think the multiples today are what they are, and you can't really predict the future, but what you can do is you can try to really understand the company's position, the market trends, and then the execution abilities of the team.
And you're leading up the growth fund at EQT that was fairly newly set up. And of course, you've got the venture fund at EQT and then the private equity part of the business. What is the rationale then for the growth fund?
That's right. So the growth fund was a little bit of the gap, right, in trying to support entrepreneurs from seed through to growth and then beyond, because we also have a public value fund. And we were seeing a lot of actionable deal flow, companies like Klarna or Spotify that weren't buyout candidates, but were now too big for the early stage ventures business, but are fantastic businesses. And so with that, we are now one of the only platforms globally that can really have these different pockets of capital and dedicated teams that can create domain expertise, operating partners that are fit for purpose for the different stages, because companies will need different kinds of attention at different stages.
Okay, so where are the opportunities in Europe right now? What are you focused on in terms of turning that firepower into real value at companies across Europe?
Right, so we look at every geo, because we think that there's incredible companies coming out of every market. From a theme perspective, we are spending a lot of time on software companies, of course, a lot of time in fintech, and of course we invested in Moly, and you just chatted to Shane, and health tech. We see that there's a lot of potential there. And then we also spend a lot of time on what we call climate tech, which is really food tech and energy tech, where we think there's a lot of disruption potential, but still not a lot of capital being invested in those businesses.
And a lot of US funding is now turning their sights to Europe as well. Is that additional competition for you healthy? Do you welcome it? What do you think underpins that sentiment from the US?
Right, and actually, of rounds over 100 million, 90% of them were done by non-European investors. So the market today really is made up of US and Asian investors. We think that's exciting for us because we are the boots on the ground, and we welcome it because, you know, capital plus talent plus success breeding success really makes the ecosystem grow. And we think that there's still a lot more opportunity in Europe.
How much of this is about funds as well turning away from China, given the tech crackdown we're seeing there? Is that something you're seeing? Is that a material change?
We haven't really seen it yet, particularly in this asset class, but potentially something we'll see.
Talk to us about the capital markets. Is this a good time for a tech startup to be listing? Or would you advise your founders to hold off as growth looks and valuations look in the capital markets, arguably fairly toppy, and where we're looking at higher interest rates longer term?
Yeah. It's hard to give a general answer because I think it depends. Some companies are ready for the IPO. And bear in mind, the IPO is just a pit stop on a journey, right? It's just a different way to raise capital. And I think now there's, you know, with SPACs, right, there's more avenues for companies that perhaps aren't so traditional in what they're doing. But I think, you know, for some businesses, they're taking big risks and they can't afford to stay private longer and take those risks in private. There's advantages to that versus having to take those risks in the public eye. But it'll really depend on the business.
Okay, Carolina Brochado, partner at EQT. Thank you very much.
Thank you.
Indeed, on the insights in terms of what has been a very, very solid year for VC funding here of the startup space, tech startup space across Europe. Guys.
Thank you so much, Bloomberg's Tom McKenzie and our guest there, Carolina from EQ2 Partner. Now, it's a busy morning for banks today. Bank of America, Morgan Stanley, Wells Fargo, but also Citi all reporting. So we'll have full analysis and coverage as they break. Now, of course, if you look at a Citigroup, it's not going to be the same because a lot of the focus will be, for example, on the investment bank, much like Morgan Stanley, Wells Fargo. Maybe we have some regulatory things that we're waiting for them to come out with. Kailey.
Yeah, regulatory definitely going to be a big thing for Citi and Wells Fargo. But for those more consumer-oriented banks, loan growth is going to be very important. We did see it up about 5% at JPMorgan, but it's been really hard to come by in the pandemic area. And for Citi, you also have to consider the credit card aspect as well. And then for Morgan Stanley, Matt, the bar is really high for equities trading because JPMorgan blew past what everybody was expecting.
Yeah, exactly. I think loan growth, you know, Jamie Dimon foreshadowed this problem last quarter, and so it'll be interesting to see how the other banks are dealing with it this quarter. But especially for our viewers, the trading aspect is going to be really important for shareholders as well as bankers who work in those departments because they're going to want to see big bonuses come Christmas.
Yes, and you know, they're very close with their customers, so maybe we could have a little bit of an idea of how much these high energy costs are actually weighing on margins and companies that they lend to. Stay with Bloomberg for full coverage.